The stakes have never been higher. Trump was just hit by a bombshell that threatens to derail his second term. What comes next is a nightmare for American households. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Trump just got hit by a colossal bombshell, but brace yourself because the next big bombshell could come from China. Plus, our tariff-beating trade is still delivering outsized returns and it keeps going even higher. Keep watching to the end of the show to find out how you too can get amazing trade recommendations and crush the market. Now, let's head over to Bloomberg, where we picked today's story up and find out about the bombshell that could absolutely derail Trump's second term and his plans for the economy, as U.S. job openings declined to 7.6 million, the lowest since September. And this is going to be the first of multiple hits to the labor market that's coming in the next several months. And this is a big problem for Trump's second term because he's trying to reshape the economy at a time it's rapidly decelerating and following the rest of the world down. The question is, can he turn it around fast enough, or will this bombshell completely derail his plans? Available positions decreased to 7.6 million from a revised 8.16 million reading back in November. That's a massive drop. The figure was below all but one estimate in a survey. So everybody at this point thinks the economy is better than it actually is. And when we look at the data, we continue to point to a downward trend where the economy keeps getting worse here. Now, rather slowly, that's the thing. And a lot of people can't even see it because it's moving so slowly down. The problem is the trend is not changing and perhaps even getting worse. The figures indicate job openings are back on a downward trend after a big increase in recent months. Now, keep in mind, everybody said there was massive amounts of economic uncertainty surrounding the election. What happened after that? Businesses came out and said, look, we're going to start building inventory. We may even hire a few people. Job openings jumped in a big way, suggesting that everything was about to turn around. And we said, hold tight, because if the consumer doesn't come out and spend, none of this hope, none of these surveys actually matter. And sure enough, that's exactly what we saw happen. Inflation still pressuring household budgets, wages not growing fast enough, workers not getting enough hours. And sure enough, now all of a sudden employers are pulling the first string on the labor market, and that should continue to suppress wage growth and supports the Federal Reserve's assertion that the job market is no longer a source of inflationary pressure. And that's absolutely right, because this is the first step of multiple blows to U.S. labor. Let's take a look at them, because the conclusion that inflation's an issue is gone. It's not going to come from labor anymore, but let's take a look at what's coming as we look at the job openings and labor turnover survey, this in blue, against average weekly hours of production and non-supervisory employees, this shown in red. And as employers start to pull job openings, they do it usually around the same time they're cutting hours. And this makes perfect sense, because if you need more workers, it means you have too much work for your existing workforce, and you start to post job openings, or you have the perception that work is going to come in and that your existing workforce can't handle it. Now, if you're pulling these job openings, well, it makes sense. At the same time, you're cutting hours of your staff. We see that happen back into the dot-com bubble. Let's fast forward to the global financial crisis. What do we see? Job openings are getting pulled. Hours worked remain rather stable until they came plunging down into the financial crisis. Look what happens around 2015. Job openings start to plateau, and amidst the same time that employers are cutting the amount of hours they give out. And look at where we're at now. Since we saw a decrease in hours worked, we've seen employers cut job openings. And notably, again, coming out of the election, what did we hear from a ton of small businesses? They said, look, we're super optimistic about the economy. We don't feel we have enough workers. And yet they turn around months later and they start cutting job openings. And this is interesting because when we look back to the University of Michigan survey that we came out recently, what did we hear from workers? They said that their confidence about their incomes going forward had plunged to record low levels. They're saying they have no confidence in the labor market, that they're not convinced that they're going to see big wage gains. In fact, some of them even said, I'm not even sure I'm going to have a job. This is exactly what's going on here, because while businesses are optimistic and hoping things are going to get better, workers are saying, we know it's not. And the next shoe to drop after workers get their hours cut, well, that means their pay increases are going to dramatically slow as well. That is, at least if they keep their job. Here we can go back again to the dot-com bubble. We can see employers cutting job openings at the same time. They cut hours, and then you see those that do have a job still, they get wage gains, but they're decelerating. And this is a massive problem because inflation inflation, as we've talked about in prior shows, is already well above where workers can actually afford. So they're already cutting their discretionary spending. Now businesses are saying, wait a minute, we're getting rid of opening positions because we don't have enough work. We still want to keep you around. We're going to give you less hours, and we're going to cut your pay increases back. This is a dangerous path for the economy, because you see when this happens, as we move forward to the global financial crisis, it's not a strong indicator of where things are headed. It means we're likely headed into recession. Now, this also tells us that any inflation from the labor market isn't going to be there, because as hours worked get cuts and wage gains slow, it means total incomes drop. And if incomes are dropping, inflation's staying higher, which is exactly what we saw during the survey data out of the manufacturing sector from yesterday. Prices are going up. They're going to push those prices onto the consumers. At a time when consumers can't afford them, you get a very big indication that Trump's biggest issue isn't going to be tariffs or trade. It's going to be the U.S. economy heading right into recession. And now let's look forward to 2016. What happened? Again, JOLT survey starts to slow down. What do we see? Hourly earnings slow down as well. Look at where we're at now. Hourly earnings have been on a downward trend for production and non-supervisory employees, and according to what they're saying, it's only going to get worse. And the hiring rate held steady at 3.4%, among the lowest in the past decade. The pace of layoffs was also unchanged at a historically low level. So notably, what we're hearing from businesses, yes, we want to hire. In fact, we even heard from the manufacturing sector. We hired up a little bit, but the data shows on net, when you look at broadly across the economy, people are not hiring. That is a big problem, because we need to see jobs created, we need to see people get back into the workforce, and we need to see them spend, or the trend in the U.S. economy will continue to the downside. The so-called quits rate, which measures the percentage of people voluntarily leaving their jobs each month, stayed at 2%. This suggests people are less confident in their ability to find a new position than they were a couple years ago. And that is a great point, because when the economy is booming, what do people do? They go to the employer and say, hey, I'd like to make more money. Odds are the employer tends to say, yes, I'll give you a raise, but not as big as one you want. They jump to another job, get that raise, and that's what happens in a booming economy. And so people have confidence. This, I can leave my job. This case, they're not confident at all. They're staying put. But something you should be confident about, way to make money in the markets. Let's take a look at our inflation busting trade. We came back out here in early January and said, put this trade on. We told our subscribers, buy it open here. It pulled back initially, and it's been on a tear ever since, making another high today. We think there's got a lot of legs to run. Now, if you want to make money in the markets, or maybe you're trading now and you want to make more money, stay tuned. I'm going to show you how, or check out the links in the description below. Be sure to grab the coupon codes while you're there, because the government's monthly employment report due Friday is expected to show hiring moderated in January. And while the unemployment rate held steady at 4.1, that's a problem, because based on what we're seeing here in the JOLT survey, is the unemployment rate's about to tick higher. Now remember, Fed Chair Powell said he thought low fours, around 4.1, maybe 4.2, was as high as it was going to get. He said this is it. But what we're seeing is a continued degradation in the U.S. labor market, all in the back of the fact that workers cannot keep up with inflation. This is playing out just as I said, but very slowly. They're spending less money on the discretionary side of the economy. It's backfeeding into the factory sector and the services sector. Hours worked are getting cut. We're seeing pay raises slow, and that means unemployment is about to jump. The report will also include revisions to payroll growth in the year through March of 2024, as well as new population estimates for the Census Bureau, so we could be setting up for a massive bomb to drop on Friday. Let's take a look at the job opening survey versus the unemployment rate. JOLT's still in blue now. The unemployment rate, this is the U3, this shown in red. And you can see the wonderful relationship between the two. As employers cut job openings, well, that means they're also not just cutting hours, they're not just cutting back the pay raises, they're putting people on the unemployment line. You see the unemployment rate rising there into the dot-com bubble. You see it happen once again. They're almost move at the same pace, where you see the cut job openings, and next thing you know, the unemployment rate is, with a small lag, heading higher. This is the first time we've seen a big decrease in job openings and not such a big increase in the unemployment rate. But if we continue to see this downward trend, if we start to see hours work getting cut, we see payroll growth slow, what it tells us is that workers are going to hit the unemployment line. And one of the problems we see in the continued claims data every week is the opportunity for workers to get back into the labor force isn't there. This is an issue because we're seeing not just a piece of the economy slow down, we're broadly seeing the entire economy slow down. Let's turn over to the factory sector here, where we see factory orders declined overall in 2025. Now, keep in mind some of the regional surveys. What did we see from the Fed? Coming out of the election, we saw this big surge in demand, and then it came plunging right back down. Let's look at the official data. As U.S. factory orders fell 0.9% month over month in December, worse than the 0.8% decline expected. But check this out. November revised dramatically lower to minus 0.8 from minus 0.4% month over month. So things worse than we actually thought. And this is where it really impacts the labor market. We talk about the nightmare scenario. This isn't just an issue for Trump's second term. This is an issue for households all across the country who are not just gripped with inflation, they have a lot of debt. And this is a problem because when you see an economy slow down, where there's a lot of people with debt, next thing you know, you start to get a massive financial crisis, a bubble building up. And when the floor drops out, well, of course, that brings banks back in the center focus. Of course, we know a lot of small and mid-sized banks are already insolvent due to the fact they're holding upside down commercial real estate loans. Some cases even taking back some of these properties. Things here are looking to get worse as households are potentially facing mass unemployment. Let's take a look at manufacturers' new orders of durable goods. This showed in blue on a year-over-year rate of change against continued unemployment claims because there's no sign that inflation is going to be here. We don't even need to look at a chart of inflation because look what happens when you see a slowdown in durable goods and even a contraction as it heads across that horizontal black line. What do you get? Rising continued unemployment claims. Now, the question is, why aren't these people getting a job? It's because the layoffs are broad-based. It's across the country. Again, it's not localized in one sector or one part of the country where a worker could say, look, I'm going to go transition from building cars to building something else. There's no opportunity, and that's the dangerous sign here. Let's look forward at the global financial crisis. We see a slowdown beginning in 2006 that broke in 2008 to the downside. What happened? Workers hit the unemployment line, couldn't find any other opportunities, and next thing you know, the economy spiraled out of control. We see the same thing happen right around 2018. A slowdown impacted the labor market. Then the pandemic hit. But look at where we're at now. You can see around 2022, continued claims bottom start to head higher. They're not going up, but they're also not going down. Look what's happening to new order growth. It remains in contraction broadly, and that is an issue because the longer new orders stay in contraction, well, factories are going to look around and say, look, we don't need as many workers, particularly once we get through the backlogs. Now, let's take a look at some of these headlines because it validates everything we're seeing right now. As Estee Lauder to cut up to 7,000 jobs in corporate overhaul, we said this was the next step. When sales drop, profits go down, earnings go down, and companies look to protect their margin. The company is forecasting net sales to fall between 10 to 12% in the 3 months ending on March 31st. Keep in mind, this is not inflation adjusted. So we look and see demand for cosmetics going down, but that's not just all. Look at ADM. They plan to cut jobs as profits head for a third year of declines. Remember, everything's fine when profits are up, but for Archer Daniels Midland, it said they're going to reduce their workforce by 600 to 700 jobs globally this year as part of a plan to achieve as much as a $750 million in cost savings. So what we're seeing is companies now realizing the economy's slowing down and they've made changes. They've cut expenses. The biggest one is labor, and that's a huge problem. Even Salesforce is in on this kind of 1,000 roles while hiring salespeople for AI. You might say, well, 1,000 people isn't much. You're right. They have a workforce of nearly 73,000, so it's not a huge number. But we talk about the fact that when people lose their job, they don't have opportunities to re-enter the workforce because look what's happening in the tech industry. Amazon, Microsoft, Metre have all moved to trim their corporate workforces. Problem for people in IT. So we're seeing this broad-based all across the country, and this is a huge problem. This is the bombshell that Trump's facing. He's trying to reshape the economy very quickly. At a time, it continues its downward trend. But the next bombshell could come soon, and from China. As Xi replies to Trump tariffs shows that China has more to lose, and this is a case they've made. We talked about why did Mexico and Canada quickly make a deal, because their economies are in far worse shape than the U.S. They were not in a position to absorb a tariff war at all. It made perfect sense for them. China now, on the other hand, looks like they want to fight back. Don't think they're going to be fighting too long, as China has been restrained because there's more to lose to its huge trade imbalance with the U.S. A full-blown tariff war is not in China's interest. Instead, China is likely to respond to tariffs mainly through domestic stimulus. And that is if they can, because what happens when countries do stimulus? The market believes it's bearish for the currency. This could put downward pressure on the yuan. So the question then is, what is this bombshell that China has? Well, stay tuned. Let's take a look at why China's not in position to fight. Because as a result of the trade war, U.S. good imports from China clearly declined with the trade war from the first round and haven't recovered a trend. This from Peterson Institute for International Economics. You can see across this dotted black line, this was the trend. And what happened? China broke that under Trump's first term, and they've never fully recovered. In fact, what we see from the rest of the world is other countries stepped up to pick up where China fell off. And now China realizes this. If they want to get into a big trade war with us, well, the problem is other countries are going to be eager to step in and take their place. The challenge for China is their economy is slowing. They can't take any more hits. And that means they may drop the ultimate bombshell, and China may loosen the grip on the yuan if Trump reignites his trade war. And this would be a dangerous all-out battle, because the surging dollar is making it difficult for authorities to prop up the yuan after months of efforts to stabilize using a range of tools. Now, the problem is this is causing the dollar to go higher. So everyone's worried about inflation. What do you see? U.S. labor markets continuing to degrade. You're not going to get inflation from there. You see a rising dollar. That's going to put downward pressure on input prices, on import prices. So even though factories are saying, yes, our prices are going up, we're going to pass it on to consumers, how much that will backfeed into the actual inflation data and for how long remains right now to only be best said as transitory. But the dollar is a big wrecking ball. It's a big problem for Trump, which is why China could do the ultimate, and that is devalue the yuan. Some analysts believe a weaker yuan is necessary to offset the impact of higher tariffs, even if the move spurs capital outflows. And Goldman Sachs says they expect the fixing rate to gradually drift higher to 7.3%. Because Beijing may be wary of further drawing Trump's ire by engineering yuan weakness, the U.S. president labeled China a currency manipulator during his first term and would probably do it again in his second term. The problem is China is not in a position to fight. Their economy is getting weaker and weaker by the day. They cannot let the yuan continue to slide without causing massive damage. So their only option here, if they want to fight and get in a protracted trade war with the United States, their only option then becomes is to let the yuan fall, let money flow out of the country. It could cause domestic inflation. It's going to be a massive problem, because it means Beijing won't be able to do stimulus. It means the PBOC won't be able to cut rates, but it's the only option China has. The question is, will they negotiate? And I think they will, or will they be forced to drop the ultimate bomb? But something we believe is going to keep going higher, well, that's gold. And as I said back on Sunday Show, if you like gold, you like this trade better, and our subscribers are loving it, and you can too. Back on January 10th, we put a buy it open on GDX. This is large gold miners. This trade is up now 7.91% as of the close of business yesterday. Now, this is from our CTA Timer Pro, where we look at machine positioning each and every day, and we give you all the broad data so you can see the positioning and how machines are looking at the market. Because what we want to do is position you in front of machine buying and then get you out before machines sell. Now, even if you don't want to look at the report, we give you notes every day and tell you exactly which ones we're looking at. You pick the ones you want to trade. It's just that simple. And that would have had you buying at open here on the 10th and then riding this rally to a near 8% return that's looking to go even higher. And here you can see back on January 10th, there was the report. We flagged it on both our fast and slow algorithms. We reviewed the trade, gave this the green light, and here's what you get. You get the report, you get the signals. I go through the trades and give you my opinions on them. I give you risk control levels. We back tested the reports. And here's the best part. You get a 30-day free trial and a full update. I tell you exactly what I'm trading, when I'm trading it, why I'm trading it. So if you just want to trade alongside with me, jump on board. Use the links in the description below, because we still have that 30-day free trial. If you can't use the links, use a coupon code. Love to have you. Love to see you too making big money in these markets, because based on where things are going, we could see equity markets come unwound, but there will be opportunities. We'll show our subscribers, and you can jump on them too. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.